Welcome to BizClass. This spreadsheet is designed as an interactive example of what a high-level forecast model may look like. You will benefit more from this tutorial if you understand the accounting definitions available in the BizClass page of my bizbean.com website. You may also wish to review the tutorials relating to net asset management and funding calculator, also available on that page. The blue cells in the spreadsheet are used for data entry, while the other cells have been locked. The Excel comments feature is also used to explain the information required in each key cell. The spreadsheet can be used for two types of forecasts. Its first use is to prepare a 5-year high-level forecast for an existing business. Forecasts are usually done during a current financial period. The forecast requires actual data at a specific point, say 9 months into the current financial year. The year-end forecast will be calculated by dividing the current trading results by 9 and multiplying the results by 12. The spreadsheet allows for adjustments to this mechanistic forecast, thus presenting a more accurate view of the final forecast. These forecast values will form the base for the start of the next forecast period. Its second use is to prepare a 5-year high-level forecast for a new project. In this case, the current forecast area should be ignored and the base values will be captured in the base column as indicated. This column will be ignored when preparing a forecast for an existing business. I must emphasize that this tool is not meant as a budgeting tool, which is used to capture details of an annual forecast in minute detail. Let's do a forecast. This tool works best when data is entered systematically from the top of the spreadsheet. I encourage you to look at the effects of the data entered on the income statement and in the balance sheet as each element is completed. It's also a good learning process. So we'll start with some basic setup data. First, we need to work out how many days in each financial period. The model does the trading calculations based on the number of days in each period. Enter the VAT rate if applicable. Now let's set up the base information. The financial results at the time of the forecast are the base. In this model, we assume that the financial results are for 6 months. The base trading numbers have been divided by 6 and multiplied by 12 to present a forecast. The balance sheet values are not forecasted this way. As you may guess, mathematical forecasts are not necessarily accurate, so the model allows for adjustments which obviously affect the forecast. Let's forecast some sales growth. Enter the percentage growth for each year. We plan to have 48 days inventory at the end of the first forecast period, but going forward we plan to improve our inventory management, so we have reduced days inventory to release cash. The price of goods won't remain constant, so we need to forecast some cost change adjustments. Now we need to recover those costs by adjusting the selling prices. The next thing affecting the trading account are inventory discrepancies and sales commissions paid. Inventory adjustments are calculated as a percentage of cost of sales, while commission is calculated as a percentage of revenue. The final item affecting the trading account is the other income. Other income is an estimated amount and the forecast is calculated as a percentage on the previous year's income. Now it's time to add fixed assets. Remember, this is a forecast, and as such we forecast on average. The depreciation rate is calculated on the aggregate depreciation for the year, and that rate is used for the future forecast periods. The model allows for additional assets going forward. The first expense item we forecast is employment. I've created 4 employment categories, which categories are based on the annual employee cost. So in the model, the aggregate category employment cost is divided by the number of employees in that category to calculate the annual employee cost base. The model further allows for percentage changes to the base cost and the number of employees per category. The operating expenses are divided into fixed and variable. The fixed expense forecasts are calculated as a percentage change from the previous year, while the variable expenses are calculated as a percentage of revenue. Let's go back to the balance sheet and set up the working capital elements. Remember, we did the inventory forecasts in the trading section. In the working capital section, we set the parameters for accounts receivable and accounts payable, as well as the values for other assets such as deposits, cash on hand, etc. If you're doing a normal forecast, you'll need to update the prior year's profit retentions in cell D179. Once that is done, we need to set up the permanent capital values. In this section, we can issue additional shares at various values. Any value above a nominal issued value will create a share premium value. After adding permanent capital, we can add an equity loan. I know it seems a bit out of order, but we need to enter the interest value and the interest rate at this point. Now let's include any term loan. Notice that we needed to include the value indicating the number of months the loan has been operational, together with the interest rate and the term period. Once all the data is entered, it's time to calculate tax. In this scenario, there is a loss for the first forecast period, so no tax is payable, and that loss is carried over to be set off against future profits. Tax rates may change, and we'll need to enter the anticipated tax payments for each forecast period. Dividends are usually paid in terms of a policy. The model presents 3 indicators to calculate a possible dividend payment, and these include earnings per share, cash balances per share, and the debt-equity ratio. Now that all the data is updated, the model presents an opportunity to evaluate the various financial reports. The evaluation will result in changes to the original assumptions, and the process becomes iterative. Let's briefly look at the various financial reports available. The income statement shows the trading results forecasted. The balance sheet shows the financial position after each forecast period. The cash flow statement shows the movement of cash between each financial period, and the ratio schedule are a good indicator of the health of the enterprise. This completed spreadsheet presents a learning opportunity. However, once you get to fully understand its potential, I'm sure you'll find it useful to do some high-level forecasts in your business. It just requires practice.